Good afternoon, everybody. Jose Fleming here with Preferred Real Estate Brokers. And today I'm coming to you with the Preb Weekly Update. We're actually going to talk about what's going on in the market. I know a lot of agents have a lot of questions as far as, is it a good time to buy? Should my buyers wait? What's going on with interest rates? What does it all mean? So today, I'm actually lucky enough to have Chris Hardiman with the Long and Hardiman Group here at Amerifirst. So how you doing today, buddy?
Hanging in there. Another
Good.
day in mortgage land.
Exactly. And actually, for a while in the mortgage business, we saw a lot of every mortgage broker was busy. Everybody was turning deals.
Yep.
Buyers agents, listing agents, mortgage brokers, everyone's busy making money doing their thing. Now, we've noticed something happen recently, and I've been wanting to ask you, what are you seeing out there right now? What does activity look like with buyers? And, kind of what's the overall temperature?
It's a really great question because we are coming out of a time that you're right. We went through a pretty unprecedented kind of 24-month run there going into the pandemic. Absolutely historical low interest rates, and you're right. It was difficult to even get a mortgage guy on the phone because everyone was jamming. We were jamming on refinances, we were jamming on purchases, all around the board. Everyone was slammed, and it was a great time for realtors, great time for mortgage guys in general, just a really booming time for our industry as a whole. So today, looking forward to kind of sharing an update with you about what's going on in the industry currently. Everyone has their sort of chief economist that they look to. National Association of Realtors has theirs, or even has their economists. And in the mortgage world, well, there's a lot of good sources to look to. We rely heavily on a gentleman by the name of Barry Habib with MBS Highway. So today I brought a lot of really interesting data that he did in a webinar recently, and I'm going to share a lot of that as we go through some topics today. But ultra high level, just to kind of address the first question that you answered or asked there, what's going on in the industry as a whole? It's still hot. It's jamming, but it's purchase driven business. So what's going on in my world and mortgage bankers' worlds? Refis are down. Refis are down 70% nationwide. And for banks like Amerifirst that were very much realtor focused, purchase driven business, they're down 95%. Because even during that kind of refi boom, we were still very much focused on our realtor partners, very much focused on purchase business. Now, having said that, purchase business nationwide is down 10%. So it's still hot, still very much, although we're all seeing a transition, and we're going to dive a little bit deeper into that, we are still seeing a market where people are buying homes, they're buying homes to occupy these homes, and it is a very, very purchase heavy market still today.
Yeah, and I kind of noticed it on my end. So we look at the number of transactions that we close, and I could tell that we're just closing as many transactions this month as we did last month as we did the month before. But what we are doing is we're seeing a lot of buyers being a little bit more cautious.
Mhm,
They're a little bit more slow on the draw as far as going out there and buying a house.
mhm.
They know they might have more options or more time, so they're kind of taking more of a slower, more cautious approach to the market. And which brings me to the next question. Everyone is talking about mortgage rates going up. And I'm just curious, what does that really mean for the consumer? And as far as interest rates versus what you see on TV, the talking heads, the news, the feds, like what does it all mean when it just boils it all down? And, explain it to me like I'm a 2-year old. What does it all mean for the everyday consumer who's looking to purchase? A seller is going to be selling a house. That's simple. That it is what it is. But a buyer making a smart decision to make a purchase, how does this interest rate affect their overall ability to purchase?
All great questions. All great questions. And when we're dialing it back, I think the most important thing to ultimately understand is what has happened to interest rates and what's driving interest rates. Because if we can't understand the drivers of interest rates, then we can't make informed decisions about when it's going to turn back around,
Okay.
right?
So what do those catalysts look like? What's pushing that?
Well, and it's complex, and we don't need to go into every
Yeah.
detail. People talk about 10-year treasuries, people talk about the secondary market and mortgage bonds and all the things that go into that. But ultimately, at the end of the day, the best thing that I can tell anyone watching that's the easiest thing to track is inflation. And what you will have, which you can look at, is just a comparison of the consumer price index, which measures year over year inflation in comparison overlaid with the 30-year fixed mortgage rate, right? And that's it. And the most simple explanation that I can give to someone, because what is inflation, right? What does that word mean? It means there's too many dollars for not enough products to purchase, right? That's what inflation is.
Mhm.
So imagine you're a lender. You're lending out your money and you make $100,000 loan to someone at a 2% interest rate. So
Yep.
you're getting $2,000 in interest a year, which you have to pay for your gas, pay for your groceries, pay for your utilities, whatever it may be. But guess what? Those things are more expensive now. Okay. So what is done in the past. You already made those loans, but now it costs you more money to live, to pay your employees, to do all those
So now I've
things.
got to in turn increase the rate to compensate for the cost of everything else that went up.
That's exactly right.
So let me
So
ask you a question.
go for it.
When you see you're watching TV and I'm at home and I see, oh, the Fed just increased the rate. The Fed just brought up the rate. Now we're just the everyday common person at home saying, oh wow, they're raising rates.
Mhm.
Now, does this necessarily mean because the Fed's raised the rate that all the interest rates on mortgages are also going up?
So yes and no. And I'm going to keep coming back to inflation drives mortgage rates.
Mhm.
Now what the Fed is doing when they're raising interest rates is they're trying to drive our economy into a recession,
Mhm.
which I will make all the arguments for why that is a good thing, but they're trying to drive our economy into a recession. Okay. Now, when they're raising the Fed funds rate, that isn't the rate that you as a consumer are getting on your mortgage.
Correct.
Okay, that is a short-term money rate. That is the rate at which banks can borrow money from one another. That is the rate that most variable rates on like credit cards are tied to. But most importantly, with that Fed funds rate, that is the rate that the huge corporations that you see when you turn on CNBC or you open the Wall Street Journal, that is the rate at which they're able to borrow money.
Correct. So these big corporations, the S&P 500 index companies, they're borrowing money
Yeah,
and they've got to increase the cost of borrowing money to these because money became too freely it's too freely available. So they're purposely trying to slow down the amount of spending.
slow down to the growth of the economy and
Correct.
ultimately drive the economy into a recession. So think about it when the Fed funds rate was zero and Amazon was thinking about spending billions of dollars on expansion of infrastructure. That's a business decision that probably made a lot of sense at that time.
Mhm.
Now, when you're looking at four and a quarter, say you're borrowing 2 points above that, now that's a decision that you need to evaluate a little bit differently, right? So when the expansion of businesses slow, hiring slows, reduction in workforce occurs, and that's when, once you have layoffs, at that point, those now unemployed previous employees are cutting in their household spending. They're bringing in the belt. Things are changing
Yeah.
there, which is an interesting kind of factor because everyone goes, well, how can you say that? Unemployment is at record lows. Like
Correct. And that's what they're saying. They're saying that spending is being cut back in general, but
Mhm.
employment is still at an all-time high. So people are still being employed, people still have jobs, but we're noticing that a lot of people are spending less money, tightening their belts and bringing back what they spend. And if
Correct.
inflation truly is a factor here, what are they doing to kind of curtail this or, help, provide some type of relief?
So again, it's very, very simple metric, right? You have too many dollars and you have not enough goods. So what the Fed can do is they can to some extent drive the production of goods, but we have an international economy,
Yep.
right? So that's a very different story. But what they can do is they can reduce the amount of available dollars in the economy or weaken the dollar for that
So
matter.
people are buying less, which allows supply to go back up to where it needs to be for a normal economy.
Correct. Spending less. And
Yeah.
if you look at the chart in front of you right now, you will see that historically, go back to the 1950s, the lowest rate of unemployment always comes directly before a recession, right?
Mhm.
So we think about all these things and we go, okay, all right, let's take out our crystal ball, right? And now I'm going to dive a little bit deeper into mortgage land here, and I'm actually going to pull up the consumer price index so that we can look at that. When is all this going to get better? Okay. And what you have in front of you right now is the consumer price index.
Okay.
And everyone needs to remember that it is a year over year snapshot of what it looked like from last year compared to this year, right? So we just got May numbers because
Okay.
the numbers always get released in the second week of the month. There's a little bit of a delay. So next week we'll be getting June numbers,
Yep.
right? Second week of July. So you look back into May, was 0.7 last year. Now we're at 1. So that's our 8.6% consumer price index, right? So that's that increase where everyone went crazy.
Yep.
It was like, wow, this is serious inflation. It's here to stay, even though they've been thinking about that for a while. Now, you look at June last year, 0.9. You're going to get next week those June 2022 numbers released, and it's not going to look like that much of a year over year spike because it was here last year.
Yeah.
It was already upon us. So it's going to help us out a little bit. There's going to be a little bit of reprieve, but then look ahead. Look ahead at the summer months last year, July, August, September, low, low. So when those July, August, September numbers hit, the year over year increase is going to be drastic and it's going to be painful. So through the summer months, you're going to have some further interest rate risk where you as an agent need to at least be mindful enough to understand what's driving that and be able to communicate, because we all know, I mean, the summer buying months, those are the hot months,
Yep.
right?
Mhm.
So you as an agent need to be able to communicate to your customer why it's happening, what's going to happen in the future, and help keep them excited and engaged in what is historically our hottest buying months, right?
Yep.
So now let's talk about coming out of that, right? You see, going October of last year into the next coming months, now we're getting into a point where those year over year numbers aren't going to look that bad.
So
So
they'll
in the
start to
fourth
level out
quarter
again.
and going into next year, this is when you as the agent needs to be having, it's been going around on social media so much, and I don't know who started it, but I love it. The marry the house, date the rate conversation, right? You need to be talking to your consumers about upcoming refinance opportunities. And this isn't the end of the world. If you need to move your family during the summer months, if you found the house that you love, pull the trigger, right? And we can talk about the cost of waiting and why it makes sense and all those things as we kind of go forward here.
So let me ask you a question real quick. And I know this is not necessarily the sexy part of our business, talking the numbers, talking rates, and so on and so forth. But this is the single most important driving factor of our business, the affordability and the ability overall that a consumer has to purchase. Now, I want to ask you, um, real quick, just kind of to veer off real quick. I see a lot of talk about adjustable rate mortgages.
Mhm.
Right now, consumers are interested in purchasing. Guys, right now, 5.5, 6%, it's still not a crazy interest rate to purchase a property, considering that, when I purchased my first home, it was at 7.25. So it's still very, very, very affordable. Don't have a conversation with consumers and let them think that it's not a good time to buy, because 5.5, 6%, it's still a great rate. Now, my question is, if a consumer comes to you and says, what about a 10-year adjustable rate mortgage where I can get a lower interest rate up front? But it would behoove us to know what adjustable rate mortgage really means and how that affects the consumer and the length of it, whether it's 3-year or 10-year. Can you kind of just real quickly explain to an average everyday consumer or a realtor trying to explain it to the consumer, what are the pros and cons of that?
Well, sure, I can do that. And the adjustable rate mortgage product, while it may seem scary, it's a pretty straightforward product. And just to clarify, because there is, even though 2008 was a long time ago, there still is a lot of stigma, negative
Yeah.
stigma
Mhm.
surrounding that acronym, adjustable rate mortgage. And that's really from the interest only adjustable rate mortgages that existed back then, where the buyer wasn't putting any money towards the principal with each payment. So those loans didn't amortize, right? So all they did was make just enough interest to get that payment through to the next month. All of a sudden, the rate adjusted on them.
So 2 years later, for example,
Aggressively
it
adjusted
would
on them.
adjust, and then the full amount would be due. So they might be paying $1,500 a month on their mortgage for a $400,000 house, and all of a sudden, 2 years later, it matures, and they're saying, now we want the principal and interest. And a lot of people got in trouble, couldn't afford it, and that's what caused our whole problem back in 2008, the housing bubble.
Correct, correct. And a lot of those loans, well, that's not the only thing that's caused it, but
Oh, yeah.
huge contributing
Yeah.
factor, right? All right. But having said that, a lot of those loans back then were also underwritten. Like, in other words, like when the lender is looking at the borrower's debt to income ratios, they weren't even contemplating what could happen down the road with those payments. And today we're in an entirely different market.
So how is it different right now today if somebody was to apply for an adjustable rate mortgage to purchase a home?
The underwriter would look at the actual monthly payment first off on absolutely a fully amortizing basis, because most of them are fully amortizing today. By all of it. But they also look at it at a risk adjusted rate. In other words, hey, where could this go? So there's risk adjusters to the interest rate and to the payment based upon where the rate could go. In terms of the actual products themselves, the most common one that we're seeing utilized today is the 5-year adjustable rate.
And how does a 5-year adjustable rate? So say if somebody got a mortgage,
Mhm.
and because it's an adjustable rate, what's the benefit for that consumer to get an adjustable rate mortgage for 5 years?
They're typically, I say that because in today's market, you're not seeing as much of a spread quite yet, but they're offered a lower interest rate today than they would be offered on, say, a 15 or a 20 or a 30-year fixed mortgage. Because the investor in that mortgage is protected, right? So again, let's go back to the example. You're lending your money out, right?
Yep.
Let's say you lend someone money for 30 years and the interest rate goes up, you're stuck.
Yeah.
You're stuck, right?
30 years. Yeah.
Let's say the interest rate goes down, they're probably going to refinance and pay you off.
Correct.
Right?
Yep.
Now, alternatively, in an adjustable rate mortgage, let's say that the person you lent that money to is fixed into that rate for 5 years, and in that time frame, that interest rate has gone up. You as the lender are protected because your interest rate at the end of that 5-year period will adjust up to whatever the factor it is tied to,
Yep.
plus some margin. It will adjust to that. So you as the investor can be sure that ultimately you'll get the return on the investment that you sort of calculated out when you made this loan, and you give them a lower interest rate today in exchange for that mitigated risk.
So there's a mitigated risk, a promise on the back end, but at this point, somebody could get an interest rate at 4.75 rather than 6%.
I'm not even seeing that big of a spread today, quite honestly.
Mhm.
I'm not selling them.
Okay.
There are some jumbos out there that are pretty aggressive.
Okay.
But in terms of conventional or FHA, I'm not seeing any of that there.
Can you say that the housing market is going to remain strong when all I see in the news every day is that, there's a housing bubble or there's an imminent threat against our industry and what it is that we do? And, you know, what do you think about that? Like, what do we tell the consumers when they keep mentioning to us, oh, there's going to be a housing bubble. I'm waiting for this housing bubble to be over or for it to hit so I could save some money on a purchase.
Yeah, I don't even know which slide to jump to on that because I brought so many, quite honestly. I'll tell you kind of where we're going to start. And first off, let's talk about, an imminent plummet or decline. And we're going to jump back into the whole recession thing real quick, because one thing that I want everyone to see and everyone to look at today when they're looking at the supporting information for today's conversation is mortgage rates and recessions, right? So the first thing that we're going to talk about as, hey, what's happening in our industry, what's actually going to happen on the back end is mortgage rates are going to come back. And the slide that is up in front of you now is mortgage rates and recessions
On a historic basis. So
on a
this is
historic
something.
basis back to 1972,
So
right?
pay close attention to this, because this is information that you want to be aware of and you want to share with your customers, because this is a historical overview of what happens with the industry as a whole.
Correct. And this is important because people keep saying, "Oh, recession, recession, recession. I don't want to buy. We're in a recession. We're going into a recession." And what you need to be able to counter that with is, "Hey, recession is going to be ultimately a good thing for our economy as a whole." And I'm not going to harp on this because we've talked about it enough, at least on mortgage rates, but just quickly take a look at the slide. Look at the shaded gray areas. That's when our country was in a defined recession, right? And look at what the interest rates did during that time period. So going back into the 80s, 18 down to 13%, looking at it back in the 90s, 11 to 875, looking at it back in the early 2000s, 7375 down to 675, 2008, 6 down to 4875. And that's an interesting recession because that was more of a inventory. There were more factors that contributed to that recession, of course, than the Fed's monetary and fiscal policy. And then the most recent one during the COVID pandemic, 375 down to 275. So that's one thing where when you're countering these talking points about, hey, we're going into a recession, you need to explain to people that that's going to create an opportunity to refinance this home that their forever home, their 5-year home, their 10-year home, whatever it may be, into a more affordable interest rate. So make that decision today if you find the one you love, right? Now, let's talk about housing during the recession. And again, this is historical data, right?
We're talking about inventory here.
Correct. We're talking about the S&P Case-Shiller, the
Okay.
U.S. National Housing Index, right?
Okay.
So starts. So this is what happens during recessions. And you will see, and again, with the exception of 2008, because we know that was a different kind of recession.
And just so you guys know, that's not going to happen again. There's been a
Yeah.
lot of stops put in place through, Frank Dodd and the US government to make sure that predatory lending and people weren't getting in over their head with stated income loans and all that stuff. So that won't happen again, but let's take a look at the chart and show us what we're looking at here.
And just to touch on that, because you hit on tons of great points, but the one you didn't hit was inventory driven, right? Inventory driven. There was so much inventory leading up to that 2008 recession, and you were able to secure financing for that inventory via a second home loan or an investment property loan. And in most of those, as you said, there was no income documentation in place. So take that one out of the puzzle here. In general, going through each and every recession, you're seeing a stronger housing market coming out on the back end of that recession than you were seeing going into it on the front end. Okay. Now, one thing that everyone always says, and I hear it all the time, and it's difficult because we as agents, as loan officers, as whatever advisory role we play in the residential mortgage industry, or residential real estate industry for that matter, we are an advisor, right? But we only get so much of our clients' time.
Yeah.
The people who get a lot more of their time are the talking heads on the news.
Yes.
So I'm just going to pull up one example that you can see in front of you now. And this is Housing Bubbles Fears, right? And it's one reporter. She's on CNBC. I want to say it's Diana Orica, but it's a common theme that you'll see across the board.
And this is a dialogue that took place here.
These are headlines.
Okay.
These are headlines, right? October 2015, Housing Today, a bubble larger than 2006. Pull your money out. Do you know how much housing values went up in that year?
Tell me.
5.1%. So if you'd listened to them then, $300,000 home price, you lost out on 15 grand. Okay. Next year, same reporter, August 2016. We're in a new housing bubble. If you'd listened then and hadn't jumped in, 5.4%. You're out 17 grand that year. November 2017, homeownership doesn't build wealth. New study finds. You listened in 2017, you're out 6.1%.
Yeah.
20 grand. Okay. September 2018, it's better to rent than to buy in today's housing market.
Not in Orlando, that's for sure.
No, not true today. You listen then, you're out 4.1%. You can see the recurring theme all the way down. And I could read them all to you, but they're there in front of you. So read them yourself. As recently as July of last year, housing boom is over as new home sales fall to pandemic low. If you listen then, you're out 18%. So add it all up, $300,000 purchase, just these annual appreciation rates, you would have missed out on $223,000 in just appreciation growth. So forget about the tax benefits of home ownership. Forget about whatever you're paying down to your principal. Forget about all that. That's just what you're out on appreciation growth. And why do the major news channels do this? Because they don't care about the truth.
They just want people to watch.
They want advertising dollars.
Yeah.
They're here to sell advertising.
It's like, if we have a sexy headline, people are going to watch it. Yeah. Yeah.
Fear keeps you glued. So that is it. And quite honestly, we're not slowing down one bit.
No, I mean, like I said, I've looked at my numbers, you know your numbers. We're still on track. People are still buying and selling. And remember, for those of you watching, we're actually in a position where we're in Central Florida. We're in Orlando, Florida. There's always going to be a market. If there's a home buyer market, there's a home seller market, there's an investor market, there's a short-term Airbnb market. There's always people vacationing here. There's always people moving here. People are leaving their states in mass droves prior to or post elections. We're always getting an influx of people here to the state of Florida. And with rent rates the way they are, there's a lot of smart, savvy renters that are thinking, maybe now is a good time to buy because I can actually negotiate with a seller and they'd be willing to, take my offer or a contingency, or maybe even pay to break my lease. Hey seller, if you pay 2 months to break my lease, I'll buy your house. And right now sellers are like, well, I see a lot of inventory coming in the market. I'm willing to negotiate with you now, where before I wasn't. Yeah. So don't let your consumers dictate to you what's happening in the market because they saw something on television. It's your responsibility as a licensed real estate agent that has the information and the knowledge at your fingertips to educate your consumers so they trust you and go to you as a trusted source when it comes to buying and selling real estate here in Central Florida.
Yeah, and you're absolutely right. We are going into those summer months where people are listing, trying to catch that family mid-school transfer family, right? So there is more inventory on the market right now. So there is an opportunity for you as an agent to get out there and negotiate stronger on your client's behalf to perhaps get a deal that you would have never been able to secure 2 to 3 months ago. It just wouldn't have happened.
Yeah, it's a lot of opportunity for those buyers who got shut out within the past 3 to 6 months. And actually, another thing too, QM loans, we've been working on some of those, in the past 30, 60 days. Kind of what do you see for that? What's the future for that? And what are your thoughts? Do they still have a place in today's market? And can you explain what that is to the people watching?
Sure. So non-QM is an acronym that means a non-qualified mortgage. So it's basically a mortgage that more so in income really than anything is underwritten outside of a different framework than how a lender or an underwriter would look at it on a conventional FHA, USDA, VA loan, right? And the most common ones that you see are your personal or business bank statement loans. Of course, we're in Central Florida, so the foreign national loan product is very popular. And really what
so it's just show me what you have in the bank and show me how much money you're making.
Correct. With the bank statement loans, certainly, hey, here's my business's last 24 months bank statements. Get me a letter from your CPA. What's your average monthly expenses? Add it all up, divide it by 12, take out your CPA's expense ratio. Here's your monthly income, right? Yeah. That's what those loans look like. But they're not going into the same aggregators, Fannie Mae and Freddie Mac, and they're not getting securitized by the same Wall Street groups that are touching the conventional and the government loans.
So it's a little looser with the lending.
It's riskier is
Yep.
what it is. And it's riskier in many instances because, as we know, Fannie Mae, Freddie Mac, these are government-sponsored entities. Jenny Mae, who is the aggregator for government mortgages, it comes with more security. It comes
Mhm.
with private mortgage insurance. FHA comes with the guarantee of HUD, right? So they're a little bit riskier to the investor, and they come with a higher interest rate, typically as the trade-off for that, right? And now that's true in a normal market, and it still is true in this market. But let's take a look at an example that I brought here today, and we can look at it, and it's very straightforward, right? So I'm just showing one simple non-QM opportunity here, right? $400,000 purchase price, loan amount 10%, down payment $360,000. Now, 30-year fixed rate on that loan, non-QM loan, 7.25, right? Which is materially higher than what is being
Yeah.
offered right now on conventional loans. Let's talk about all the bad stuff, right? Let's talk about the annual property tax increases on the house, let's say 2%. Let's talk about the repair cost estimates. I just put in $166 here. Well, actually, it's Barry's example, so he put in $166 because if you were renting, you wouldn't have to pay those. And someday you're going to go sell that property and you're going to have to hire a licensed realtor and you're going to pay that licensed realtor 6% to sell that property, right? So let's just look at average appreciation. I used a 62-year historical average at
Yep.
4.36%,
That's right.
which,
Right around 5%. Yep.
yeah, right around 5%, right? We all know that's way different than what we've been experiencing the past, 3 to 4 years, and certainly way different than
And
what
and
we've been
and, and
experiencing
eventually it
here.
is going to come level out back to 5%.
Yeah. So let's just use that example,
Sure.
right?
Conservative.
All right. Comparable rent, monthly rent, let's say $2,100 a month is what you'd be paying to stay in that $400,000 house.
Mhm.
Not Central Florida, but okay. Be more than that here, but fine. Let's say that goes up 6%, right? Here's the math, right? And we have to take into account a couple things when we're thinking about this. And by the way, this tool that is here is available to any realtor that works with us. And quite honestly, MBS Highway is a very popular tool. If you don't work with a loan officer at the Long and Hardiman Group, your loan officer may have this available to them, quite honestly. But regardless, this is a tool that is available to you. You can run these numbers. You can use this as a tool for any of your buyers, right? So let's just talk about straight out of pocket cash flow difference, because a mortgage payment is higher than a rental payment because you are paying your property insurance, you are paying your taxes, you are amortizing your loan, you are paying a little bit of principal with every single payment. So straight cash flow difference out of pocket over a 9-year holding period, $28,000 out. But there's more to that equation. You have to take into account appreciation, right?
Mhm.
In that same time frame, using that very conservative,
5%.
let's not say
4.6.
conservative, let's say
4.6. Yeah. It's a
data driven.
It's a yeah.
Data driven. It's a historical data driven number.
Yeah.
$189,000 worth of appreciation during that same period. You've paid that loan down $42,000
Mhm.
during that time period. Okay. Take into account a very conservative tax benefit based upon a 22% tax bracket, right?
Mhm.
Got to pay your real estate commissions. So
Yep.
that's going to cost you $35,000 to sell that property.
Mhm.
Now, here's the deal. Even with that 7.25% interest rate, which it may be a little bit higher than that in the non-QM space today, not horribly, 9-year hold, you are ahead $164,000 over deciding to rent instead of paying that higher interest rate. Say you only hold at 6, oh well, you're only ahead $77,000. You only hold at 4, you're still ahead $34,000. So you, as a realtor, need to be educating these buyers that are sitting on the sideline, even if it's over, hey, today I can only get a non-QM product available to me, even if they're years away from doing whatever they need to do to get themselves into a conventionally financeable position. If you're armed with the tools, or even are able to go to your loan officer partner and ask them to arm you with the tools, you can still make that person a home buyer today.
And this is what you're telling realtors and your loan officers to be showing, using tools like this to show the consumer that it's still safe to come out and play.
That's exactly right. And in this market, again, when there is so much fear on the news, on the media, everywhere, you need to be armed with real tools, real education, real industry knowledge to become more, and I hate the term door opener, but I'll say it, more than a door opener, you need to be an advisor. You need to help them
Absolutely.
make smart financial decisions.
You're supposed to technically be the person that they go to for any real estate needs, any real estate questions. They come to you as their confidant, as their advisor when it comes to real estate sale, real estate purchase, real estate investment. So having access to these tools, and is there something like we could provide a link or something where agents can have access to a tool like this, or?
Yes, they can have access to the
Yeah.
tool because of RESPA. They do have to pay for that
Okay,
access.
I understand.
But it's
So-
like $10 a month.
Sure, but this
And
is it's a valuable tool.
Correct.
So we can
Yeah.
put the link on this for you guys. But you know,
Yeah.
worst case scenario, you go to your loan officer or your mortgage partner like Chris
Well-
here, and he can go ahead and punch in the numbers for you if you're trying to convince a buyer to make a purchase that's going to be ultimately beneficial for them, even at an ultra conservative year over year 4.67 annual rate of return on or increase in property equity. And then this is what, a 9-year model that you showed them?
Correct. And the nice thing is if you do use it, then at that point you can actually co-brand all of these materials. You can put your logos on it. You can do everything.
Put it on your social media, just let you, because what you should be doing is, remember Jerry Maguire, show me the money. Well,
Yes.
this is the one where you're like, show me the numbers.
Right.
Show me the numbers. Help me make a decision. Help me help you.
Correct.
Right. So, you know, this is a really cool tool. And I think agents should be kind of screaming at the top of the mountain, like, look, here are the facts. Here are the figures. Here are the numbers. This is factual, data driven information for years and years and years of
Yeah.
the housing market.
And non-QM aside, because you won't run into that as often,
Mhm.
but cost of waiting is happening left and right today. You know, oh, I'm going to wait for the market to crash. Okay, you got to be ready to correct that with, again, just data-driven knowledge. Okay, I'm going to wait for interest rates to come down. All right, let me show you what that cost is going to be for you to actually wait, question mark, for however long it may take for interest rates to come down. You need to actually show them the foregone appreciation, show them how much they would have amortized their loan down, right? And what is amortization? It's paying down your principal. It's like moving $1 from one savings account that you own to another savings account that you own, right? Which, quite honestly, the house savings account is right now returning a very much higher rate of return than your savings account at Chase Bank, right? So you need to show them all of these things, and don't make life more difficult than it needs to be. Don't go make an Excel spreadsheet and do it from scratch. Use the tools that are available to you.
Now, do you see that are agents and buyers still calling you saying, hey, we're in a situation where we're trying to buy a house. You know, can we swing it if we're going to pay $20,000 or $30,000 over market value? You know, what is the temperature you're getting back from your agents out on the street and buyers getting loans? Are they still tripping over themselves to pay more than market value?
It's happening. It is certainly, you know, and I don't like them. I think you should come in strong with your best offer and give a tight window for acceptance. But I'm a different kind of negotiator. I'm still seeing a lot of escalation clauses in offers, which are coming into play still. So there are offers still being made over asking price. And the question that I'm getting more so, can I swing it? Although I love that realtors are coming back to me and checking, hey, can you actually approve the borrower for this before they're making this offer? Because that's a good realtor. So if you're going over what your loan
Double
officer
check.
told
Double
you
check.
they were pre-approved for, double check. But more so, I'm getting the question from the buyer saying, hey, does this make sense? And again, it needs to be a very data-driven analytical conversation. And the tool that you can see up in front of you now is a very straightforward tool that, again, you can utilize, which just shows, and it's It's dialed in. It's all the way down to the property address, the zip code. It's nationwide data. It's plugged into an AVM, which is an automated valuation model, for those of you that have not heard that acronym before. And it tracks historical appreciation in the marketplace. And it tells them, based upon how much they're offering over the list value, how many months it would take for them to basically break even on catching up with the appreciation of that property. And with the example here, which is out in Nevada, you see that it's an 8-month approximate break even if you're going to go 5.1% over the list price with your ask. And it's not going to be like that everywhere. So it may be 80 months. And you know what? In that instance, it might not make sense to do that.
Yeah.
Unless, you're going to be there
Yeah,
for a really long time. And
that's
it's everyone's individual
and that's
scenario.
what I'm looking at now. I only see people over asking price right now in the more popular zip codes or more desirable locations.
Mm-hmm.
And the people that are like, we don't care, we love it, this is exactly what we've been looking for, we're going to be here a long time, we don't mind paying more than it's worth because we got to have it.
Yep.
And that's what's happening out there. What do you say to people out there that are still saying, hey, could you mind if I pick your brain? Do you think it's a good time? Should I just wait for things to calm down a little bit? Should I wait a few months and then poke my head out and maybe go out and try to get a loan and buy a property after waiting for everything to calm down? What do you generally tell them? Yeah, wait a few months, or let's see what happens after summer, or what does that look like?
The conversation kind of varies between if it's a primary residence, a vacation home, or an investment property. The dialogue changes a little bit, and the outputs of what I'm kind of saying back to the consumer changes a little bit. But by and large, 90%, probably greater actually, if I went back and looked at the data, is to the primary residence buyer, particularly here in the Central Florida market. We're still having so many people move into the state, and they are buying homes to put roofs over their family's head.
They need somewhere to live.
Correct. They need somewhere to live. And in that instance, I'm not advising anyone to hold at all. If you found the home that you love and the affordability matches where you need to be for your family, pull the trigger, get in there and try and secure that home. And then if you need to right side the interest rate down the road, do that.
So yeah. And I tell these people all the time, I'm like, listen, you have two options here. You have a small window of opportunity. You have 3 months to find a home, buy it, purchase it, move into it. And if you don't pull the trigger and make that decision now, what's going to happen is you're going to have to go into another rental for 12 months at exceedingly high rental rates in the area, because you still want to keep your kid in the same school district of the house that you're going to move into this time next year when you poke your head back out.
Yep.
But you're going to be paying $2,800 a month for a 3-bedroom apartment.
Yeah.
And you're going to throw all that money away, none of it going towards your equity, none of it going towards paying off of your mortgage balance. And when you come back out of it, yeah, maybe a property is going to be a little cheaper, but think of all the time and money that you wasted over that year renting and coming out with even a higher interest rate, because we know that's going to happen too.
Yeah.
So what are you telling realtors right now to help them grow their business, or to help them, build that buyer confidence right now? What are you telling them to help them?
So in the first instance, I'm telling them to dial in on the data. Now more so than ever. Like, again, I've said it already. There's fear on the TV, on the radio, on the internet headlines, on your phone. You need to dispel the myths about interest rates, about inventory, about the housing market, about everything. And the only way you're going to be able to do that and be taken seriously is to educate yourself, right? So if you're not going to take the time to research the data, learn the data so that you yourself believe it because it's there, no one else is going to be taught that same lesson by you. So that's the biggest thing. And the other thing that I'm advising realtors to do is communicate that message on as wide of a platform as you possibly can, right? Amplify your message. Get it out there and do it on social media. Do things like we're doing right now. And by the way, I do not enjoy this. This is not my
No,
personality
I mean,
type.
this is a little stressful for me. I
Yeah.
need a drink.
Correct. Yeah. This is not the way I like to be at my computer with my headset on, taking my pre-approvals, doing my thing. Getting on the microphone, getting in front of the camera is not my personality type. But if you want to take advantage of this opportunity to grow your business as much as you possibly can during this window of opportunity, because believe me, this is going to be a window of opportunity. There will be realtors leaving the industry. There will be loan officers leaving the industry. There already have been. Every single loan officer that got their license back when the refinance boom hit is gone, right? They can't transition
Yeah.
into purchase business driven loan officers. So there's going to be attrition within your competitors, and you need to seize the day. You need to take advantage of that and get your message out and take your business to the next level. So other than becoming the best fact-driven advisor that you can possibly be, I would tell you to get outside of your comfort zone and do the activity that you never wanted to do before.
Research, information. And remember, the agent with the most information always wins. If you have information and data-driven information that you can show to your consumer, that's ultimately what's going to matter the most. Because when people say, I'm waiting for a housing market to bust, or I'm waiting for prices to come down, I'm like, well, where
Why?
where are you getting this data? Like, who's telling you this? Explain to me where you're getting all this from, because if you can't explain to me where you're getting the information, at least I can explain to you where my information is coming from. I could back it up, and I could show you every bit of metrics that you need to know and to be informed to make an educated decision about making a purchase. Come with me. Let me show you. Let me teach you. And if you're the agent that could do that for the consumer, you'll win every single time. Because when they ask you, how's the market? And you're like, it's fantastic. That's not the answer they're looking for. They're saying,
And everything else they're looking at is contradicting that.
yes, you need to say, hey, it depends on your situation, but if you're looking to buy for you and your family, let's plug in some metrics and let me show you what your dollar is going to do for you today over time, historically, versus, just saying, hey, it's a good idea to purchase. Just go with me and take my word for it. I think it's better that you educate them and show them all the information that they need to make a decision. And knowing a lot of agents, like I know, they probably watched this for the first 5 minutes and they kind of zoned out and turned it off. But there are a few of you that continued watching all the way to the end. And hopefully you picked up some really good information or topics of discussion or some great tools that Chris mentioned that you can use to back up all of your information to help you get that edge over the agents that aren't educated and aren't doing this extra work for their clients. So Chris, I want to thank you again for joining us. I really do appreciate your time. And other than that, I'll see you guys next week with some more updates and some great information to help you with your business. Take care.
Thank you.